let's discuss the valuation of preferred stocks. Now, preferred stocks have a higher priority than common stock, but they don't exercise, the preferred stockholders don't have the managerial control that common stockholders have. What they have is the right to be paid before the common shareholders. Now, when preferred stocks are issued, they pay a dividend, and that dividend is promised in perpetuity. So the preferred stockholder is paid a dividend. There's no maturity date, and that becomes important in terms of valuing a preferred stock. So it's not an annuity. An annuity has an ending date. This is a perpetuity. It has no ending date. It does have a fixed payment, so in that regard it looks similar to the way an annuity would look. There's not a binding contractual obligation to pay interest as there is with debt. However, if they don't make a payment, if the company doesn't make a payment, it can't make payments to its common shareholders as ordinary dividends either. So it has a strong incentive to make those payments. But preferred stock is more flexible for the corporation than common stock is, in that although it's promised, if times get tight, it's possible to defer paying the preferred stock dividends. So preferred stock is a hybrid security that doesn't have the ownership privileges of a common stock, and it also doesn't have the legal enforceability of debt. Having said that, if the common shareholders want to pay themselves a dividend, they're going to have to pay the preferred stock its dividends first. Now, how do we value a preferred stock? Well, a preferred stock is a perpetuity. And by a perpetuity, when we refer to a perpetuity, we mean a stock that is paying dividends. In this case, the dividend is DP here. It's paying dividends every period, and it's paying them forever. So out here at the very end, you see a little infinity sign. That's the very last dividend being paid. It's paid out there forever. The first payment is going to come at the end of the first period, so it might be nice to put a little 1 here to designate that one. This is the second one, the second payment, but all those payments are exactly the same amount. I'm just designating when the time is. Now, the various terms are defined here. The P sub P is the price of the preferred stock. Let's put a little 0 in. That's the price today. The DPs are the annual dividends, the first one coming a year later at time 1. And KP is the required rate of return, or the discount rate, for preferred stock. So this is, in a very real sense, the cost to the corporation of the preferred stock. In the same way that for a bond, interest is the cost of the bond that's outstanding, for preferred stock, the cost is the rate of return, the yield, in terms of the dividend. So you can think of this little K sub P as an interest rate. It's like an interest rate. It's a required return, this term right there. Okay. Now, a perpetuity, all of this, it turns out this is what's called a geometric series. This perpetuity will collapse into a very simple formula, and that's the formula. The price of the preferred stock is equal to the amount of the dividend that's paid annually divided by the required return. And this, just as a point of emphasis, this preferred stock is being valued at time 0, and the first payment is coming at time 1. Okay? If that's not true, this formula doesn't work. The formula only works for pricing a security at the beginning of the period, not for pricing it at the end, where the first payment is coming at the end of the period. So it prices at the beginning with the first dividend payment coming at the end. So let's assume an annual dividend of $10. The preferred, let's pop back up, the stockholders require, preferred stockholders require a 10% rate of return. So the price is the $10 divided by the 10% required return, which we have right here, is $100. So we just plug those numbers in. After the stock is issued, it's going to continue to pay $10 forever, but that doesn't mean that the required return by shareholders, by preferred shareholders, is going to stay the same forever. So the value of the preferred stock, just like the value of common stock, is going to change over time in the market. Now, remember that the longer our bonds had outstanding, the farther off the maturity date, the bigger the impact was from a change in the required return or yield to maturity. The same principle applies here. And how far off is the maturity date for preferred stock? Well, it's a perpetual security, so the maturity date is forever. It never matures. The maturity date is out there at infinity. So changes in interest rates, say inflation rates, or other rates, have a bigger impact on the price of preferred stocks than for any other security. Let's assume that the required rate of return on the preferred stock we just looked at changes from 10% to 12%. If that happens, the amount of the payment that's being made every period doesn't change, but the required return does, and so the price of the preferred stock is going to change. So assuming that our payment is going to come 1 year from now, that dividend payment, the only thing that changes, I'll just circle it in blue here, the only thing that changes in the formula is that denominator. The discount rate is now 12%, and the price has dropped from $100 to $83.33. If interest rates subsequently fall, or if required returns, interest rates basically, subsequently fall, then to 8%, the value of the preferred stock is going to rise. Remember, our bonds, when required returns rose, bond prices fell. When required returns fell, bond prices rose. They went in opposite directions. The same thing happens for our preferred stock. When our interest rate or our required return falls to 8%, the price of the stock rises to 125. So the only thing that's changing is the interest rate, and because the interest rate changes, the value of the preferred stock is going to change. What doesn't change is the dividend amount. Once the bond is issued, it pays a stated dividend. It's going to continue to pay that. It's the market's required return that changes, not what the bond is paying. Now, frequently we know the rate of return on a particular, we know the price on a particular security. We can observe the market price, and we know what the contract terms are. We know what the dividend payments are. We want to infer from that what the market's required return is for our particular preferred stock. This might be useful to us, so we know if we issued more preferred stock, how much we would expect to have to promise in interest in order to, or in terms of dividends, in order to raise a given amount of money. So we can take the perpetuity formula that we had earlier. The preferred stock was a perpetuity that was valued as this. We just reorganize all of that. We know the dividend amount that comes at time 1. We know the preferred or the price of the preferred stock at time 0, and we can find the cost of preferred stock. We solve now for KP instead of for the price. We solve for the cost of preferred. That's why we're using a K. It's the cost of the preferred, or the interest rate. We solve for K. So let's assume that we had an annual payment of $10 per share, and we observe that the price of the preferred stock is $100, what is the required rate of return? In other words, what's the yield on the preferred stock? Well, we just plug in DP there, we plug in the price there, and we find the cost of the preferred stock is 10%. Again, the higher the market price, the lower the yield. So when prices go up on our preferred stock, that's a signal that the required return on the stock has declined. If we wanted to issue more stock, we could expect to issue on better terms than we did previously. If the price rises from 100 to 130, the required return on preferred stock has fallen from 10% down to a little less than 8%.